all that was not there earlier. So number one, is the auditor independent? He has to be. Has the auditor done a good job? Audit committee has to decide that. Has the auditor followed the process that is required to follow? Audit committee is required to do that. The challenge for the auditor now would be in terms of independence. He is required to sign only 20 balance sheets. That 20 balance sheets also will be including private limited companies. Again, I am not too sure if he has got partners in the firm who are tax partners or who are advisory partners, who are not actually the auditors. Can they sign the balance sheet? Still, it's a gray area. Independence of an auditor, which means that the auditor, his relative, his dependents, should not be holding any shares in the company, number one. Number two, they should not be indebted to the company. And number three, not just the company that they are auditing, but the holding company, the subsidiary company, associate company, and the fellow subsidiary company. It's going to take auditors a few months and years to figure out whether his brother or mother or father or sister or daughter is holding shares in the company and the circumference against this particular company. Look at the law. So every auditor within the firm, every audit partner within the firm will be required to give a confirmation to the firm that not only he in his individual capacity is independent, but he along with his relatives, father, mother, wife, daughter, son, brother, sister, daughter-in-law, son-in-law, stepdaughter, stepson. Everybody has to be independent of that company. How are you going to do this? And in what frame of time are you going to do this? The appointment of the companies are coming up. Maybe it's applicable for next year, doesn't matter. But can you tell your brother or can you tell your sister with whom you may be having an arm's length not to go and buy the shares of our company where you are auditing? Can you go and tell them? I think the auditor himself will never go and share anything. But now it's becoming much more stricter. This was also there as a part of the code of conduct, as a part of the ethics, fine. But now it's forming part of the Companies Act. And any non-compliance in this regard will result into auditor being not independent, and that confirmation, the auditor has to give it to the board of directors and to the audit committee as well. So initially the audit committee will take a confirmation of independence from the auditor that he and his partners are independent of the company and the subsidiary of the company and the parent company, fellow subsidiary and the associates. It's going to be very, very difficult. Number two, the performance of the auditor also will be reviewed by the audit committee, and if the audit committee believes that the auditor has not carried out the audit in accordance with the audit process, the risk-based approach, the audit methodology in accordance with the standards of the institute, then they may think of removing that auditor and appoint somebody else as well. The third responsibility of the audit committee is to examine the financial statements and the audit report thereon, which means that what are the disclosures in the financial statements? Are there any remarks made by the financial statements? Are there any comments in the financial statements referred to by the auditor? Are there any qualifications in the audit report? Is the audit report clean? Is it qualified? Is it disclaimed? Is it adverse? Somebody should be able to understand, and if the chairman of the audit committee is again not somebody who is having that professional qualification, I don't think that the chairman will have that particular level of knowledge to argue with the auditor. That's my personal view. Definitely the view can be different, but this is something that we need to think about as well. If there are any related party transactions, then they need to be approved by the audit committee. Even if there are related party transactions and the audit committee is not happy about it, fine, you can make a modification out there. If the audit committee believes that they were not at arm's length, they need to be made at arm's length, and then that modification has to be made. And again, the audit committee is also required to scrutinize intercorporate loans and investments, because many a time, it's again a good thing, many a times a company will give loan to another company in the same group, invest in any other company in the same group. Now the audit committee is required to investigate and look into intercorporate loans and investments. Now the next point that I'm going to talk about, I'm not too sure whether it's a law or whether it's a mistake. But now the audit committee is also responsible, and I'm using the word responsible, for the valuation of undertaking or assets of the company. So let's say that if a company is doing a valuation of the entire company as a whole or of the assets of the company, normally the audit committee would take a note and challenge the valuation where necessary. Here it is required to take the responsibility of that. So you may engage a valuation expert to do that, but the company will have to take the responsibility of the fairness of the price at which it is being valued. So I'm not too sure whether it's a drafting mistake or it's a real thing, but we believe that the Ministry of Corporate Affairs wants the audit committee to take the responsibility of the entire valuation and not just supervise the valuation. The next important one is evaluation of internal controls and risk management process. Now, internal control will be reviewed by the internal auditors of the company. That particular process is also overseen by the Chief Financial Officer of the company, the CFO. But now the audit committee will take the responsibility of evaluation of internal control. So if the audit committee is not happy with its own internal auditor, who is a part of the company, they may engage an accounting firm or any other firm to do a specific internal audit to gain the comfort that the internal controls are operating effectively or not. And finally, if there are any funds being raised through the public, if there is any IPO or if there is any FCCB or if there is any kind of a GDR or an ADR and you are raising the funds, how those funds are being used? Are they being used in a manner in which they are supposed to be as per the prospectus, or are they being used for some different purposes? All that will be required to be reviewed by the audit committee. In addition to that, if there is any problem with financial reporting, with risks, the board will refer that matter to the audit committee. The audit committee is duty bound to do an investigation on that particular matter, come to a conclusion, and report it back to the board. So for example, if there is a fraud, if the board tells the audit committee, it's audit committee's responsibility to make sure that the fraud is investigated, the extent of damage is being determined, the process of recovering that particular damage, including police complaint, imprisonment, whatever, the time frame within which that particular money has to come back to the company, or in case if the money cannot come back, to what extent the loss has to be written off, at what point of time it has to be written off. All that will be the responsibility of the audit committee to be presented to the board. So audit committee again is going to be having an onerous task of ensuring financial reporting discipline within the organization. We now come to the next committee, which is called the Nomination and the Remuneration Committee, a very simple one. You need a committee within the board of directors. So now friends, when I talk about committee, this committee does not mean anybody and everybody in the organization. This committee is formed only from the board of directors of the company. Nobody else can come on the committee other than the members of the board. The Nomination Committee and the Remuneration Committee is a committee which is going to be deciding about who is going to be on the board of directors after evaluating the qualification and the experience of that individual. And if they are coming on the board, what should be the remuneration? Having given the remuneration, they are also required to review the performance on an annual basis. And based on that, is there an increase in the remuneration or a decrease in the remuneration? What kind of commission has to be paid to each director will be decided by the Nomination and Remuneration Committee, and then will be approved by the board, and finally will be approved by the shareholders. So this is a new committee. It was even existing earlier as well, but in the real pro forma now, this committee is empowered to decide about the individuals who will come on the board of directors and their remuneration and their commission. It's mandatory in the case of listed companies and some other public companies. It will include 3 or more non-executive directors, of which half of them have to be independent directors. So that means that if there are 3 non-executive directors, 2 will have to be independent directors. If there are 4 non-executive directors, it will be 2 independent directors again. If there are 6 or 7 people in that particular committee, more than 50% have to be independent. So first of all, entire committee should be having non-executive and executive, of which 50% will have to be independent directors. It will determine the qualifications, positive attributes and independence of a director. So look at it, when a new director is going to be inducted, it will decide, okay, we need a director. That person has to be a chartered accountant or a lawyer or an expert, let's say if it's a company in the business of drilling oil, so they will need an expert who has worked maybe in ONGC or in Oil India or somewhere. They will bring that individual with the required level of expertise. And they will also evaluate the independence of a director. To what extent that director and his family is holding shares in the company. Is it more than that 2% limit which is being given currently? If it is more, the director is disqualified from being an independent director. And then this particular committee will be having a policy, will be having a laid out document relating to the remuneration of the directors and the other key managerial persons of the company. So again, the threshold is that listed companies are required to have this committee, and public companies again with the same thing, 10 crore of share capital, 100 crore of turnover or outstanding loans as of the prior balance sheet. If that triggers, such companies which are public companies will be required to have remuneration committee. Here there is no transitional period. You are required to have that committee in place right away. In some cases we are getting that transitional period of 1 year, but here you are required to have committees in place right away. One more committee, which is basically the stakeholders relationship committee, what we used to have earlier called shareholders grievances committee. Now we are calling it as a stakeholder relationship committee. These committees are required if the number of shareholders, deposit holders, debenture holders, and other security holders exceeds 1,000 people. 1,000 people or 1,000 body corporates at any point of time during a financial year. So let's say that right now a company where I'm working is not having 1,000, but during the year there was a rights issue. Sorry, there was a further IPO. There was a public issue. And now the shareholders have become more than 1,000. At this point of time, I will be required to constitute a stakeholders given committee, and the composition of the committee is left to the board. The board can decide what should be this committee. We now come to a very, very important committee called Corporate Social Responsibility Committee, what we call as the CSR committee. And as I mentioned earlier, CSR is not mandatory. It depends upon the company as to whether they would want to make that contribution. If they are not in a position to make contribution, then they need to explain in the board report and to the ROC and to the Ministry of Corporate Affairs as to why they have not made that contribution. It is resting on a very simple principle which we used to have in the British days called either pay or explain. If you are not able to pay, you explain as to why you are not able to pay. So some of the companies which meet certain criteria should be having a committee called the CSR committee, consisting of minimum 3 directors. So minimum there should be 3 directors on that particular committee, and it should have at least minimum of 1 independent director. So it doesn't matter, there can be 5 directors, there can be 6 directors, but a minimum of 1 independent director should be forming part of that CSR committee, because of the fact that somebody has to review it and challenge it independently with the other executive directors about the CSR plans. Now, which are the companies which are required to have a corporate social responsibility committee? Here the triggers are very different. Number 1, whether net worth is more than 500 crore. So if the net worth is more than 500 crore, irrespective of being listed or not, it should be having a corporate social responsibility committee. Turnover of more than 1,000 crore. Now look at the first 2. Net worth of more than 500 crore, turnover of more than 1,000 crore. So you tend to believe that CSR should be applicable to those big companies, 500 crore companies, 1,000 crore company. But look at the third one. Net profit of 5 crore or more during any financial year. Now look at it. That means that every company is covered practically. Private limited company, public limited company, listed company, if their profit is more than 5 crore, it gets covered from a CSR perspective. I do not know the reason why the first 2 are on a higher side and the last one is on the lower side. I mean, it's completely a mismatch here as well. But these are the requirements that we are required to follow, and all these companies where even any one thing will trigger, they will be required to have a CSR committee. Now there is a concept called the report of the board or the board report. And that board report under the new Companies Act has to be informative and should have adequate disclosures or extensive disclosures. So what are the requirements out there? It should have some of the extracts of the annual return of the company, which is being filed. Recommendations of the audit committee not accepted by the board. Now this board report, if you recollect, I had mentioned earlier that that goes to the Ministry of Corporate Affairs, it goes to the ROC. Look at the kind of information the government wants. If the audit committee in its right manner has made recommendations to the board, and if the board has not accepted those recommendations, then automatically it's escalated to the Ministry of Corporate Affairs. Compliance direction by the independent directors, which means that if there is an independent director, then he has to give a certificate of his compliances of he being an independent director. Even that will have to go to the Ministry of Corporate Affairs. The fact that the CSR policy has been developed and implemented. So even the government would like to know that whether you have developed the CSR policy and have you implemented that policy. And a statement, they want a statement from the board of directors in relation to the annual evaluation of the board, which means that the nomination and the remuneration committee should have done that evaluation of the performance of the board and the individual directors in the case of listed companies. And that particular statement has to be made in the report of the board that this evaluation has been done of all the individuals and accordingly people have been remunerated and their performance has been assessed. Next one. Now that's the one which is going to be very difficult if the independent directors are coming from a good pedigree. It says very clearly whether the company has developed and implemented a risk management policy. Now this can be in form and may not be in substance. So if you recollect, I had mentioned about the enterprise-wide risk management framework, I had mentioned about internal controls, gaps in the designs, operating effectiveness, review and the sign-off by the process owners, sign-off by the CFO, sign-off by the CEO. In substance, all that will build up a good risk management framework, and that is something which has to be done for the board to make a statement that they have developed and implemented such a policy. My analysis of this, definitely it ensures more transparency in the proceedings of the board. All the boardroom discussions which were between the four walls now is going back to the MCA. And therefore, the disclosures also have to be very, very carefully drafted. So let's say that the recommendations are made by the audit committee and not accepted by the board. Once it goes to the ministry, it will become a public document. So the people who are going to draft the board report, they have to carefully draft the board report to make sure that even if this document goes in the public domain, it should not damage the company, it should not tarnish the reputation of that company. Then I think the board of directors report also requires any commitments or any contingencies or any material changes subsequent to the year end. So let's say that there is a major event that has happened subsequent to the year end, which could have resulted in a major loss to the company or whatever. It can be an adjusting event, it can be a non-adjusting event, which we have learned in our accounting standards. Even those disclosures have to be made in the report. And most important, if there are any related party transactions, and if those transactions are not in the ordinary course of business or not at arm's length, which means that it could be not at arm's length, it could be not in the ordinary course of business, even those disclosures have to be made in the board report. Now I'm very worried about it over here. How can the board approve something which is not at arm's length? How can the board approve something which is not in the ordinary course of business? And having done that, how difficult or how easy it is going to be for the board to make a mention in the report when that report gets filed with the regulator. So these are all fancy things to hear, but whether it's going to be implemented and whether people are going to write about all these things, whether people are going to minute it, it's a question that we need to sort of think of, and maybe time will say about it as well. Then we have got something called the director's responsibility statement. In addition to the board report, the directors are required to make a statement of the responsibility. This, I believe, again can be a duplication or a repetition because it talks about internal controls, whether the directors have laid down internal financial controls to be followed by the company and that they are adequately and operating effectively. Friends, look at the kind of importance that the company's directors are now being given on the internal controls. It keeps repetitive again and again. It came so many times in my presentation. It's coming in the board report, it's coming in the director's responsibility statement. The directors have to lay out internal financial control architecture. They will be responsible for that architecture. Somebody can come and design. Any consultant can come and design, but they need to take that responsibility and they need to make sure that it's operating properly. They need to evaluate through somebody. They need to be convinced about that because they have to sort of finally give a statement in the report saying that they are operating adequately and effectively. So now, if you look at it, the requirements of this internal control to ensure orderly and effective conduct of business. I mean, this is a new concept which has come over here as a part of the board responsibility. It says that the board does not even take responsibility of only financial decisions, but even the operating decisions. It looks at the efficiency of the operations and the operating effectiveness. And the auditors will also be required to give a report on the internal financial control to ensure orderly and effective conduct of the business. So until now, under CARO, we were reporting as to whether there are proper internal control measures underlying purchase of goods and services, purchase of fixed assets, and sale of goods and services. We were reporting that under CARO. It was only confined to certain things, goods and services and fixed assets. Now the auditor will be required to ensure that whether the board has implemented the system of good internal control framework, whether that framework is operating effectively, and the auditor will be required to make that statement in the audit report as well. So for me as an auditor, the challenge will be that the board of directors will feel that the controls are operating effectively, but genuinely the controls may not be operating effectively as examined by the auditor, and the auditor may want to give a different disclosure in the audit report, and that is where there will be a problem between the audit firm and the board of directors, and there will be a disconnect. Unless the board will convince the auditor or the auditor will convince the board, the two different organizations cannot give different report. The board cannot say it's fine, the auditor cannot say it's not fine. So these are the challenges now that we will be facing as audit firms, as companies, where there will be a disconnect on the prevalence of internal control in any organization. So now we have a definition of a related party for the very first time under the Companies Act. Earlier, the definition was forming part of the Accounting Standard 18. Now we have. There is no central government approval. Now it's a good thing. If you have a related party transaction, no central government approval is required. No central government approval is required for any appointment of any director or for any remuneration or anybody. Any in related party transaction not in the ordinary course of business or not at arm's length should be approved by the board. So the board will have to be fully convinced of those transactions and should be approved by the board. That's okay. Some of the other miscellaneous provisions relating to, I mean, the others were not so important in terms of analysis. I'm not covering that. Some of the other provisions where directors and all are concerned. Duties of directors now have been defined for the very first time. So now you have a complete list of duties for which the directors are responsible. If the directors are not conducting the duties in the most appropriate manner, then significant penalties will be there for the defaults of such duties. There is a new section which is being introduced, a new clause has been introduced in relation to prohibition of insider trading. You cannot carry out as a director any insider trading. You may be a director in a company. You would know the financial performance of the company. You would know exactly what's going to be the financial results on the date of the board meeting. You are aware that the share which is quoted at 100 rupees right now will become 200 rupees in the next 15 days. So now you have, through some other channel, invested in more shares in the company based upon the insider information that you were subject to. People will do different things, but if it is being caught, then there are significant penal provisions, not only in terms of losing the directorship, not only in terms of fine, but even in terms of imprisonment. And this imprisonment can be anywhere from 6 months to 3 years. So the law is going to become very stricter for anybody having a position of a director and who makes profits out of insider information. Any key managerial person, now key managerial person includes the CFO, the company secretary, and any other non-executive director. Any other person who will be actively involved in the affairs of the company. For example, senior vice presidents and other people who are privy to information. If they are caught trading based upon the insider information, then the penalty also will be levied on them in terms of fine and imprisonment. So it's not only applicable to the directors, but the definition of KMP is extended to define a CFO, a company secretary, and others as well. The 1956 Act was not very clear about prohibition on insider trading, but 2013 Act lays down very clear provisions on insider trading, and there is a complete clarity on that. There is a good harmonization between the SEBI Act and the Companies Act 2013, because SEBI was giving specific provisions of penalties for insider trading. Now even the Companies Act is also giving the same. They are completely in harmony, and therefore they are applicable as well. And if anybody is caught, he will be punished with a cash fine or imprisonment or both. Generally the cash fines in India, I think the gentleman this morning from the Ministry of Corporate Affairs, he mentioned very rightly that forget those days when the cash fines were 500 rupees and 1000 rupees and 25,000 rupees. Now they are in lakhs and crores. So people have to think twice before they get into all these things. Whistleblowing mechanism. Whistleblowing mechanism is now coming mandatory for all listed companies to set up a vigil mechanism to make sure that if there is any problem, the problem gets escalated. So what is a whistleblowing mechanism? If you recall, clause 49 of the listing agreement also mentioned about the whistleblowing mechanism, but it was not mandatory. So when the auditors or the company secretary was certifying the norms of corporate governance until now, whistleblowing was not mandatory. However, now, only for listed companies, a whistleblowing mechanism is mandatory, which means that at any point of time, if you believe that there is a problem, or if you are seeing a fraud, or if at all somebody is harassed in the company, or somebody has not been given justice in the company, then there should be a mechanism, there should be a procedure for that person to escalate the complaint. The complaint can be seen by a committee of people. That committee of people should be reporting to the audit committee, and if the matter is very serious, it should be going to the board of directors as well. So somebody will blow a whistle. It doesn't mean that the whistle when being blown is a genuine one. Internationally also it's being seen that more than 30 to 40% of the whistles blown are not